Good evening, everyone. Today we're looking at business management and finance. We'll continue from our previous topic, which is financial management. Now, today we'll be looking at the financial market. Or the financial market. And when I say financial market, I'm talking about the market whereby financial instrument is being traded. So this is a market. Now, what is businesses and the source of finance? So what is businesses and how does it raise finance? Businesses raise new finance to invest. Long-term finance is needed to invest in long-term assets and working capital. Short-term finance might be needed to help with cash flow problems and to ensure that the entity has enough funds to pay its suppliers and liabilities on time. Finance has a cost because the providers of finance to a company to a company, because the providers of finance to a company expect a return on their investments. Financial managers therefore need to have an understanding of the financial market. Now, the provider of finance, they request or they expect a return on the risk they takes in investing in a particular company. Now, source of finance may be classified under various categories according to the following important headings. So we're saying, how can a company or a financial manager acquire finance, or how can they obtain finance? So we have different categories whereby we source of finance can be categorized. One, based on the period, based on period. So finance might be categorized based on period. So when I put a period, we have the long term source and the short term source. So when we say the long term source, was talking about the finance that will take a large number of time for the company to repay, and the volume of finance received in this source is usually bigger than the short term finance. So long term finance may be mobilized by long term or short term. When the finance mobilized with large amounts and they repayable over the period with more than 5 years, it may be considered as a long time finance. So any finance that's been repaid over a longer period of time, usually more than 5 years, we say is a long time finance. And what are those examples of finance? What are the long time finance? We say equity shares. Now, the equity shares are normally obtained from a recognized stock exchange. So equity shares, white two, we have a preference shares. So preference shares can also be obtained on a recognized stock exchange. Now, debentures, this is a debt capital. It's a debt capital. So, and we have long term loans, maybe a loans from banks or loans from individuals. Then fixed deposit. When you make a fixed deposit in a particular company. So maybe there's a fixed deposit in a company. For example, the entity is a finance house. So a fixed deposit into the entity is a source of finance to the entity. Short term source. Now this is different. This is any other finance which is different from long term source is called short term source or short term finance. Apart from the long term source of finance, firms can generate finance with the help of short term source like loans and advance from special banks. Money lenders, etc., short term source of finance needs to meet the operational expenditure of the business in concern. So how do we get a short-term source? So the short-term source of finance include what? The bank credit, customer advances, trade credit, which is your payables, your trade payables, or your trade receivables. So these are short-term funds. Um, Factoring. A factoring is whereby you use a finance house. You sell your debtor to them, then they give you money. So your debtor is a short-term finance. So when you sell your debtor to a factoring house, so the money you receive from a factoring is also from short-term finance. Now, public deposits, like normal banks that deposit fund in the banks. So we said those interest, those public deposits, they are also short-term source of finance to the entity. Money market instrument. What's a money market instrument? We're talking about all those instruments that can be traded on a recognized stock exchange, like your treasury bill, like your commercial paper. All these are what? They are money market instruments. Now, source based on source of generation. Now, when we base this on source generation, the source of finance may be classified into various categories based on the period. Now, how do you generate them? Are those finance you obtain, are they qualified for are they derived internally or are they derived externally? So I say based on how they generate, is it internally or is externally? Now the internal source, like your retain earnings. Your retain earnings that the profit the company makes will be a source of finance for the company in the future. So the retain earnings, depreciation funds, like companies makes a special account for depreciation, whereby they, when they purchase a particular asset, the depreciation on that asset is being um recorded in a particular account, whereby those money must be deducted from their profits. So that money will be recorded, will be kept in a particular account. By the time they needed um finance to acquire non-current asset, they will now use the depreciation account fund to finance such projects. Surplus. Now any surplus like your revaluation surplus is also part of your what internal source. Now external source, a share capital, when you issue shares in the recognized stock exchange, it's an example of external source. Debenture also, when you issue loan in the recognized stock exchange, is also example of public deposits. Like for a bank, for example, when money being deposited to the bank is used is for an external party, that's your debtors. So it's also an external source. Loans from banks and financial institutions. So when you receive loan from the bank, we say they are external source. Now the financial intermediary. Who are these financial intermediary? In a in a financial institution or in a financial environment, there's always an financial intermediary. Those that come, those that comes. Now, now the financial intermediaries, we say in a financial environment or in a financial sectors, there's always an financial intermediary between the borrower and the lender. Somebody will come in between them. So those people are called, or those individual or company are called the financial intermediaries. A financial intermediary is a person or organizations that that operates between savers, which is the investors, and the borrowers. Their role is to redirect the funds of sellers and investors to the individuals and the organizations that need to obtain such finance. So these are the financial intermediary. They come between the borrower and the lender. For these reasons, financial intermediaries have evolved to bring lenders and the borrowers together. So they bring the lenders and the borrowers together. These financial intermediaries include the banks. So banks brings the borrower, which is those that want to borrow fund, and those that deposit fund. So they bring them together. And while the investment bankers, these are those people that helps in the selling of new shares. They help a company to sell a new shares. So those that purchase the shares and the company that sell the new shares, they are the intermediary between the two parties. The insurance companies and the credit unions. For example, a bank raises funds by borrowing, like taking deposit and lending that money to other borrowers. So these are one of those function of banks and the financial intermediaries. Now, the financial market. Now, what is the financial market? Now, this is the market. This is not. This is just like a market, as your usual market where you see the buyer and the what the seller. But in the financial market, they are not selling. They're not selling tangible assets. They're not selling cars. They're not selling they're not selling inventories. They sell financial instruments. And the financial market brings together organizations and individuals wishing to obtain finance, and organizations and individuals wishing to invest. So people that want to obtain finance and those that want to invest. So these are the intermediary between them. For example, now a recognized stock exchange is a financial market whereby is a market where the seller and the buyer meet. In addition to the bank lending markets, the financial market can be classified as capital market or money market. The capital market can be classified into, so in the capital market, so we have the equity market and the bond market. In the capital market, we sells is the market that sells those both the equity and the bond. Now, capital market might be domestic market, might be international market. So the capital market are financial markets for primary issues and secondary market trading in longer term investment, equity and bonds. The capital market are both national or international. So in capital market is divided into two: the primary market and the secondary market. Now, the primary market is used by companies to sell shares to investors for the first time. For the first time, for example, by issuing new shares to raise cash. The primary markets, the primary capital markets are therefore a source of new long-term capital for companies, government, and other organizations. So the primary market is an initial market. We call it the initial market, where the initial offer of any financial instrument, be it equity or bond, is issued for the first time. So the first issue, the market whereby the first issue of equity or bond is being issued is the primary market. Right, the secondary market is used by investors to sell shares that they own or to buy shares that are already in issue. So in the secondary market is already market whereby you will see those brokers where an existing shareholders want to sell his shares, and someone they want to buy can buy from the existing shareholder in the secondary market. So the secondary market is the market where an existing shareholders meet with an investor that want to buy shares that's already been in existence. Now, the stock market. Also, a stock market. A stock market is a market place for buying and selling shares in companies that applies to have their shares traded on the exchange and whose application is accepted. It acts as both a primary market and a secondary market for shares. So the stock market, just like as our Nigeria Stock Exchange, it is a stock market whereby you can buy your shares of companies in the stock market. So in the stock market is divided into two parts, the primary and also the secondary. What is the main function of the stock market? We said one, provide a system in which sales can be traded in a regular manner. So when you look at the stock market, they provide a system, a platform whereby shares can be traded in a regular manner. So that platform, when you go there at the recognized period of time for trading, you always buy and sell your shares. Enforces enforce rules of business conduct on market participants to ensure fair dealings. So the stock market, which is for in the case of Nigeria, the Nigeria Stock Exchange, they also regulate the rules for trading. So where there will be a fair dealings, there won't be what we know as what insider dealing, whereby a a director or an employee of a company will use his insider information to purchase the shares or to sell the shares of the company in a recognized stock exchange. So it has information in which the seller does not have. So in a recognized stock exchange is not allowed. The three ensures that there is a efficient system for providing new financial information about companies to investors in a market. So ensure that there is an there is an existence system for providing new financial information about companies to investors in the market. So in the stock exchange also, that's the reason why they said we have an interim financial statement whereby company will present their financial statements interim quarterly, so that investor will have information on the companies they want to invest on. Then the fourth one is provide a system for recording information about the price at which shares are bought and sold, and provide share price information to participants in the market. Now let's look at the money market. The money market. The money market. The money market. The money market are also also markets for dealing in short-term lending and borrowing, and for trading short-dated financial instruments. Now we say the money market. The money market is a market whereby there's high volume of trading in short-term financial instruments, both borrowings and lending. So there is high volume of trading of such an instrument. So when we say an instrument whereby you can buy and sell a short-term financial instrument, we say that market is a money market. A money market. Now in the money market, we have the wholesale market mark for large volume transaction. And that is the characteristics of a money market. We also have a short dated financial instrument. A financial instrument that have 1 year or less to maturity when they are issued. When they are issued. When they are what? Issued. They include treasury bills. They include treasury bills. Now they include the treasury bills, bills of exchange, commercial paper, and certificate of deposit. The repo market, which is one of the money markets, also deals in short-dated bonds with short time remaining to maturity, as well as other money market securities. Now, the main money markets are the interbank market and the repo market. Now, the main money market is the interbank market and the repo market. So the purpose of the money market. So the main purpose. So we said the main money markets are the interbank market and the repo market. Now, the purpose of the money market is the main purpose of the money market is to provide short-term liquidity to entities needing money. So short-term liquidity is always provided in the money market. Short-term investment opportunity for entities with surplus liquidity. So if a company that has surplus cash and they want to quickly invest it for a short-term period, so they can use the money market to do so. Now, what is the interbank market? This market is always within the bankers. So the market is being used. It's a sort of money market within the bankers and few banks representatives. Now, the interbank market is a market for borrowing and lending large amounts of money for short term, often overnight, that's for one day, but mostly possibly up to 1 year. As the name of the market indicates, it is mainly a market for borrowing and lending between banks, such such as explained earlier. Companies are able to participate directly or through their bank. That means this interbank market, company might also be part of it, but the company cannot come itself. So it will come through its own bank. So the bank will help the company to trade in that interbank market. That means if a company XYZ Oil and Gas wants to participate in the interbank market, he will use his bank. For example, we can use the Globus Bank PSC as his representative in the interbank market to trade on his behalf. So it will be the bank that will trade, not the company SYZ Oil and Gas. And interest rates in the interbank market vary according to the duration of the loan. So the interest rate is based on the loan. So and because as you know, the trade-off between the risk and return is that the higher the risk, the higher the return. So the longer the period, the longer the return. And two is the credit rating or credit status of the banking of the borrowing bank. Now, bank that is borrowing, all banks they are not, we have what we call credit let me say credit risk rating. Um this credit rating are always done by some finance house, some big investment banking companies in Europe and also in Nigeria. So we have one of S&P 500. So this credit rating, they will rate companies based on their um risk default. So based on their capacity to repay loans, in regards to repay loans. So we have companies that have strong capacity, companies that are lesser risk, that when you invest in such a company, you can be assured that they will pay back your loan. I mean, the company cannot um, liquidate in a foreseeable future. So the company are that almost equivalent to a like country. That means those of us they have what we call AAA. They are so strong. Why other companies we have AA, we have BBB, we have BB, we have B, we have CCC, we have CC, we have C. So that is how the risking for the company that have the highest risk they have the lowest risk default, the lowest that they cannot they will pay your risk, they will pay your loan as when due. They are AAA. So that's why they keep dropping down to C. Now, what is a repo market? A repo market is a market and repurchase transaction. So, in a repo transaction, a party sells a quantity of short-dated bonds or markets or money market securities to the other party, and at the same time undertakes to buy them back at a specific future date at a higher price. Now, this repo market is just like an option, whereby in the repo market you will sell your short-term security to a particular buyer, and at the same time there will be an agreement that you will buy it back in a particular time, usually higher than the price you sell it. For example, you have a short-term instrument that you sell for 15 naira, then you may buy it back maybe after 1 month or after 2 months at the rate of 55 naira. So that is a repo market. You will sell and they have an option of repurchasing it back, or buying back clause on that instrument. Now let's look at money market instruments. What are those instruments traded in a money market? What are these instruments traded in a money market? Now the largest money market is the interbank market for loans and deposits. There are also markets for dealing in other money market instruments or security, including treasury bills, bills of exchange, which is including bankers' acceptance, certificates of deposits, commercial paper. Now we have a coupon bearing and a discount instrument. So some money market instruments can be coupon bearing, while some can be discount instruments. Now, what is the meaning of coupon bearing instruments? Now, the coupon bearing instruments are instruments or securities on which interest is payable at a stated interest rate on a fixed amount of principal. So I would say a coupon bearing instrument. We are saying it is a type of money market whereby, or the type of instrument whereby there will be a specific interest that will be paid on a principal annually or monthly or quarterly. This is what we call a coupon bearing instrument. For example, when you buy a debenture is always a coupon bearing instrument. They will say you have 15% debenture. That 15% is the interest rate that we paid on the principal of that debenture. So 15% of the amount you invested is what they will pay as interest. Now, discount interest or discount instruments are instruments or security where the borrower undertakes to pay a fixed amount of principal at maturity, and the instrument is issued at a discount to its face value. Now, when we say the difference between the discounted issue price and the eventual redemption price, that is the face value, represent the interest on the borrowing. Examples of discount instruments are the treasury bills, bills of exchange, and commercial papers. When we say discount instruments, we are saying this kind of instrument whereby is being issued at discount. Is being issued at discount. For example, the nominal value or the nominal value or the face value of bond is always 1,000 or 100 naira. That is per unit. Now, if you want to purchase a unit of a treasury bill or a discount instrument, now what I'm saying is that instead of you giving the company or government 1,000 naira, which is the face value to purchase a unit of that bond, 1,000, they will say you bring 90 naira. Now, when you bid the 90 naira, at the end of the maturity period, which is maybe after 1 month or after 1 year, they will not pay you the 1,000, which is the face value. Now, the difference between the face value and the issue price, the amount you purchase it, is the interest. Now, let's look at the money market instruments one after the other. They just have a little understanding. One of them is a treasury bill. What is treasury bill? Treasury bills are short-dated securities issued by a government when money is needed to meet a short-term finance requirement. Treasury bills are normally issued. So the treasury bills are normally issued for 21 days. Sorry, 91 days. That is 3 months. So treasury bill and treasury bills is an example of a discount instrument, a discounted instrument, whereby in a treasury bill, the amount, the issue price is always at a discount of the face value. So when you want to buy a treasury bill, what a unit is 1,000 naira. The issue price will be like 900 naira. So that 900 naira times the unit that you want to purchase, they will give you the face value. Now, bills of exchange. A bill of exchange is a form of promise to pay a stated amount of money at a date in the future, usually in several months' time. A bill has a drawer and a drawee. So a bill has a drawer, and those that the person that draw the bills, and drawee is the bank that they draw the bills upon. That is now a bill of exchange that is drawn on and accepted by a bank is called a bank bill. So once it's been drawn and accepted by the bank, it's now called a bank bill. Might be used as source of short-term finance by the companies in two ways. So once the bank have accepted the bill, now the bill cannot be traded in any money market as a method of financing foreign trade business. So you want to buy, you want to purchase a trade business, you can use your bill to bill of exchange to pay for that um transaction as a method of raising short-term finance by means of bankers' acceptance as an alternative to bank borrowing or issuing commercial papers. That is bankers' acceptance. A company that intends to borrow money or borrows amount of money for a short term over a period of time in the future might arrange a BA, like market acceptance program, with a bank. Under these terms of the agreement, the bank undertakes to accept bills of exchange that are drawn on it by the company up to a maximum amount. When the company needs short-term funding, it draws a bill on the bank accepts it and then sells it in the money market on behalf of the company at a discount. So bill a bank acceptance is also a discounted instrument. Now, what is a commercial certificate of deposit? CDs, certificate of deposit. Certificate of deposit is a certificate issued by a bank stating that the bank is holding a specific quantity of money as a term deposit on which interest is being earned at a specific rate. The deposit cannot be removed from the bank until the end of the stated term, but it can be sold in a money market for CDs. Now, certificate of deposit is like when you want to make a fixed deposit in a bank, the bank will give you a certificate that okay, this amount you've deposited in the bank for a certain period, and you cannot withdraw that money until the maturity date or the date in which is stated for you to recoup your money. Now, and you needed money on a short time, urgently. That's because you can sell it in the money market. Sell it in the money market. And certificate of deposit is an example of a coupon bearing instrument. Now, a commercial paper, large credit worthy companies have several ways of raising short-term finance and might select the least cost financing method. This might be borrowing at money market rate from a bank, arrange a BA program, or issuing commercial paper. The cheapest rate of financing might vary according to the conditions in each of the money markets. Commercial paper is an unsecured promise note. A commercial paper is a promise by the issuer of the notes to pay a specific amount of money on a specific date. When a company issues CP, it's promised to pay the face value of the paper at a specific date in the future. So the commercial paper is unsecured. It's unsecured. It's an unsecured debt. So once a company issues a commercial paper, is unsecured. So it's not secured on any asset of such a company. So, but you are telling me that okay, We will pay you. You cannot secure that debt on the company's asset. So, but I think they will pay you at a particular period of time. But they will. It's always a discounted instrument, but they will pay you the face value. So with this, we've come to the end of the topic, financial management. After this topic, we should be able to understand what is the financial management, what is finance, what is business finance, and what are the method of type of finance, and what is a financial market, and what is money market. All this is you able to understand that. So in our exam, we should be able to write something on the financial management. So with this, we've come to the end of the topic. Good night.